I'd like to thank Brian and the Chamber for having us back. Some of you people might have been here last year when we had the kind of kickoff breakfast, and kind of a stark contrast to where we were about a year ago. I mean, you remember how the end of 2018 was with the stock market meltdown and the Fed raising rates, and everybody was pretty jittery about what 2019 was going to hold for us. And you know, I've been accused by my colleagues at times of looking at the world through rose-colored glasses, but at the time we said that, you know, things don't look quite as bad as we see in the media, and we illustrated some reasons why we thought that 2019 might outperform what conventional wisdom had. And fortunately, it bore out. In fact, we had a pretty good year. What we're going to do today, I'm not an economist in the true sense of the word. As Darpin said, I started out as a bond trader. And back in the dark ages of the 1980s, before the internet and so forth, you found out about the markets either by looking at the Wall Street Journal every day or the New York Times business section. On Saturday, you had Barron's. But the news was kind of old and so forth, and we kind of relied on the data that came across the broker screens that would tell us that, you know, the employment number was up last month, or retail sales were doing this. And we kind of had to guess the direction of rates, because certainly back then the Fed was like Grant's tomb. They wouldn't tell you anything. You kind of found out after the fact that they had raised rates and so forth. Where today we've got 24/7 business coverage, and, you know, minute to minute, every time you know, the Fed chairman, you know, sneezes, you hear about it in the paper and so forth. But I'm not sure we're any better informed than we were 40 years ago. So today, what I'm going to do is run through some slides. I call it the lightning round because there's a lot of things to cover. The economy looks pretty good right now, and it's not just a few sections. There's a lot of sections, and we're going to try and run through and look at them. So on this first slide, this kind of shows the history, you know, going back about 5 years. And if you look at the 5 years before that, it was a similar story. But the U.S. economy has continually climbed what we call the walls of worry. Every time there's something that comes to the news, it causes everybody to have heart palpitations, whether it's, you know, the Fed raising rates, Brexit, the election, the spike in oil prices. We see the market's blood pressure go up, which are the red lines at the bottom. At the same time, the stock market takes a hit. But as you can see, each of those tended to pass by, and stocks continue to make higher and higher highs. And if you looked at the 5 years before this, you'd see things like, you know, Greece, when they were going bankrupt and threatened to pull down the rest of Europe, sequestration, the fiscal cliff, Ebola. There's always something going on that causes the market to get worried, but we seem to pull through it in a pretty good way. On the next slide, you know, part of the reason for that is the U.S. consumer is carrying the water, if you will. You know, they've been in good stead. Employment is growing pretty strongly. Jobs and wages have been driving spending. We just last Friday got the December employment report. We added about 145,000 jobs, and the market was kind of like, well, that wasn't quite what we were expecting, but maybe it's 10,000 less. But part of the reason for that is, you know, Thanksgiving was kind of late this year. So what happened was the people that got hired to do work and so forth, a lot of that fell into November. So November we had 245,000 jobs and 145 in December. But on average, we've been running up in the 175 range. What's interesting, though, is that employment gains have slowed down a little bit. At the end of 2018, we were adding jobs about 2.5% per year. In 2019, we slowed down to about 1.3. Now, that's still making gains, and when you consider the fact that the U.S. economy is, I don't know how you define it, but pretty close to full employment. And we'll talk about what our companies are saying, but, you know, the biggest problem out there for a lot of people is trying to find quality workers. We don't expect the gains to be that strong, but we only need about 100,000 jobs every month to keep the unemployment rate down around 3.5%. And we think as this year goes on, we'll probably see that number slink down a little bit more. Some other news out of the employment report, obviously, what was interesting was the U6 measure, which people say, well, you know, the unemployment rate of 3.5%, that doesn't catch all the people who are on the fringe. Well, U6 catches the people on the fringe, the people that are part-time workers looking to trying to find full-time jobs. That fell down to 6.7% in December. That's the lowest number on record, which goes back to the early 90s. Also, prime age workers, those between the ages of 25 and 54, 83% last month, and that's the highest it's been since 2008. So the numbers are looking good. Earnings fell a little bit. We went down just below 3% on a year-over-year average. But wage gains are really driven by inflation, and since inflation has been only 1.5%, there hasn't been that impetus to raise wages, but I think we'll see some pressure on that in the year ahead. On the next slide, just taking a look at locally, New England and so forth, look at job growth around the footprint. Connecticut, about 0.2% in job gains. Rhode Island led the way, followed by Massachusetts and so forth, but a little bit behind the rest of the country, but gains nonetheless. On page 4, the next slide, getting back to the consumer for a second, to give you a sense of how well the consumer is doing right now, the Fed puts out our quarterly report on household net worth, and that looks at things like 401ks, savings, real estate, and so forth. And as you can see, this is at the end of the third quarter. We haven't got the fourth quarter numbers yet. We continue to set new highs in terms of net worth. So what's interesting is obviously the stock market has a lot to do with that. Look at financial assets going up. Real estate has started to add to the lift, with house prices rising 3 or 4% on an annualized basis. At the same time, debt has remained relatively constant. In fact, consumer debt, even though you read in the papers, it set new record highs. We're only up about 10% from the peak we saw back in 2010 when everybody was maxed out and so forth. So that's a good story there. On the next slide, give you a sense of how good consumers' pocketbooks are. You look at consumer leverage, spending and consumption and so forth was up last year about 6.5%, which is the strongest year we've had in about 15 years. And despite debt being at an all-time high, when you look at assets or disposable income as a percentage of debt, we're at levels we saw really back in the 1980s and so forth. So consumers aren't really getting overextended. And by and large, a lot of them have been reticent to really jump on their credit cards and so forth. I mean, they've been kind of paying as they go. And the fact that wages are staying ahead of inflation, they have the wherewithal to spend without having to take on too much more debt. On the next slide, that kind of bears itself out in consumer confidence surveys. Whether you look at the Conference Board, which puts out one report, or the University of Michigan, which puts out another report, we're up in pretty high levels. Look at the bubble back in the 90s when we had the tech bubble, how high it was back then. We've been averaging about 126 over the last 3 years, and that compares with a rating about 74 in the prior 10, so good news there. On the next slide, looking at small business confidence, a similar story. The Small Business Administration has been trending about 105 over the last 3 years, and that compares with an average of about 93 over the prior 10. And what's interesting, when you look at the readings of the reports, the things that they complain about, which used to be things like taxes and regulation and so forth, most small businesses say their biggest problem, as I mentioned earlier, is trying to find quality workers. On the next slide, looking at some of the general sectors of the economy, we've heard a lot about manufacturing and what the tariffs and the trade war and so forth have done to kind of beat it back a little bit. This survey is put out by the ISM, and it's a survey, so sometimes sentiment gets in there a little bit, but we've gone on now for about 5 months now below 50, and these indices, we call them 50-50 indices. So if a reading below 50 means that things are contracting or getting smaller, and vice versa. So when things are up there, then the economy's expanding. But manufacturing only makes up about 11% of the U.S. economy, even though we're producing more than we ever have in our history. So we're kind of raising our eyebrows a little bit at these numbers because, as I mentioned earlier, demand last year set 15-year highs. So unless manufacturers start to ramp up production, and we think that'll help this week, when we talk about the settlement of the trade, the first phase of the trade negotiations with China and the USMCA getting in place, we think that'll start to turn around. But if manufacturers don't pick up the pace, they're going to wind up losing businesses to foreign competitors and so forth. Another survey that's not on here, the IHS Market Survey, they hit a 7-year high in November and almost held that level in December. And the difference between the two reports is the one that hit the high in November looks at predominantly small to medium-sized businesses, where the ISM up here looks at multinational companies, so a little bit of a disconnect there. The next slide looks at the biggest sector of the economy, the service sector. And we hit 55 in December, which is very strong. When you get up around 55, it's very strong. When you get up to 60, where we were a while back, you're in nosebleed territory. But the service sector is both business activity and new orders are both strong. What's interesting, prices paid is moving up close to 60. So that's another reason why we think we might see a little bit of lift in inflation. Another sector of the economy, real estate, obviously, this is the first recovery we've had since the Great Depression where the recovery wasn't led by real estate. And part of that is because of the problems that the real estate sector had with the meltdown in 2008 and 2009. There were so many houses underwater, all the foreclosures and so forth, that real estate was actually a drag in the economy for the first 4 or 5 years of the recovery, but now we started to turn a corner. As we see here, new home sales, we're up 1.3% in November, so about 17% year over year. We're starting to see more demand for new home sales, and they've been running at about 70% of housing starts. So as ground gets broken, they start to build a house. 77% of those are getting snapped up right away, and the historical average is just under 70%. So you kind of get the sense that builders are falling a little bit behind the curve here. Existing home sales, if you go back one page for a second, existing home sales are also on here. They're about 70% of the residential market and so forth. They're only up about 2.7 year over year. The big story here is just a dearth of supply. I mean, normally most realtors will tell you about a 5-month supply of homes for sale is about average. We've been well under that now for about 3.5 years. So there's not a lot of supply out there, particularly in the short end of the market. Houses under 250,000 and so forth are almost non-existent. So it's making it a little bit harder for the first-time buyer to make their move into the marketplace. And then if we go ahead to the next slide, looking at housing starts, we're starting to pick up the pace. Depending on who you read, most analysts say that we need about 1.5 million new homes each year just to keep up with demographic growth and replacement of obsolete homes. And we haven't been there since before the Great Recession in 2010. We've been averaging about 1.2, 1.3, but that number is starting to move up a little bit, and we think that's going to be, it's going to cause residential real estate to add to GDP this year a little bit more than they have in prior years. On the next slide, we talked about fundamentals, the consumer, housing, and manufacturing and things like that, but also looking at technicals. We like to watch what's going on with credit spreads and so forth to kind of get a sense of how nervous the market is about debt and people's propensity to borrow. Most of our clients on the commercial side, part of my job at the bank is advising them on how to put debt on their books. So a lot of our clients use interest rate swaps to take their commercial loans and fix the rates on them so they can budget with certainty. And the swaps are priced basically as a spread over treasuries. So if you want to lock up money for 10 years, you look at the yield in the 10-year treasury, and there's a spread added to it. And that spread goes up or down. And as you can see, those gray periods on the chart, which are recessions, obviously when we're in a recession, we see a big spike in yields. And what this chart tells us is right now, the spreads are relatively low, so there's not a lot of credit concern out there just yet. If we look at the next slide, credit default swaps, which is another way of hedging if you own a lot of corporate bonds. The spreads on those obviously go up and down, both for high yield and investment grade during a recession, but both of those are down at pretty low levels. And so what it tells us, there's no real signs right now of systemic risk in the economy, and there's plenty of liquidity out there. So the next slide, if there's one slide I could show today because of time constraints, this would be the one I would show, because right now we're in the longest expansion in history, and that causes a lot of people writing in the papers and so forth to say we're getting close to the end. And obviously we're closer to the end of this recovery than we are the beginning, but it doesn't mean it's going to end tomorrow. Most recoveries, any recovery, doesn't die of old age. The Fed murders them. And the way they do that is you look at this chart, every recession going back to 1960, there were two things that happened before the recession. Number one, the blue line was up and the red line was down. The blue line is real Fed funds rate, which is Fed funds rate minus inflation. So, back in, 1970, the blue line was up around 4%. That meant that Fed funds were around, 6% and inflation was around 2%. At the same time, the yield curve, and we just got done listening about the inversion of the yield curve for the better part of last year. When the yield curve gets inverted, and that means that, normally short rates are here and long rates are here. When the yield curve gets upside down, inverted, that also tends to lead to a recession or as a precursor. So when you look at the far right-hand side of the curve, we started to see the blue rates go up the end of last year as the Fed raised rates for the third time in 2018. But then they cut them 3 times in 2019. So we basically have Fed funds today around 155, and inflation's around 1.7, 1.8. So the real rates are actually negative by about 1/4 of a point. So not a concern there. And secondly, the yield curve, the 1 year is around 157, the 10 years at 183. So it's positive about 25 basis points, which is better than it was 6 months ago. So with nominal GDP today running about 4.8%, and that's GDP plus inflation, and that's been the average over the last 2 years. With Fed funds at 154, the Fed is no threat to the recovery. And the fact that they're going to sit on the sidelines gives us a lot of confidence that 2020 is going to be, almost as good as 2019. On the next slide, looking what the Fed deals with, obviously they follow inflation. And right now, we just got the CPI number out this morning. I didn't get a chance to look at it, but it's been running it just broke over 2%. The Fed likes to follow another number called PCE, personal consumption expenditures, which has been running around 1.7. So they're not really concerned about inflation just yet. But as we know, those numbers take in a lot of factors. And, if you're fortunate enough to be able to live, buying cars, big screen TVs, and other technology things, and you don't need food, you don't need to go to the doctor, and God forbid have a kid in college, the services costs, there's inflation and there's inflation. So, but it is percolating in the background, and that's one of the reasons why we think that we'll see the Fed possibly think about, if not raising rates this year, at least as we get to the end of next year, we'll be talking about perhaps rates going up as opposed to going down. On the next page, just to give you a contextual sense, here's the 10-year Treasury rate going back over the last 25 years. We were at 3.5 November of 2018, and we came down to 182 today. There's a number of reasons for that. We've got low rates. First of all, people's expectations about growth this year aren't that great. I think consensus, as I mentioned earlier, is somewhere around 1.8%. At the same time, global demand is there. So we've got a lot of global investors spending money in the U.S. Number one, they're worried about their own economies, perhaps. Number two, we're one of the few economies in the world that had yields above zero. So if you're trying to get any type of return, you'd come to the U.S., and that has helped to keep rates down here. But basically, rates and so forth, we expect wages are going to start to push on inflation, and we do expect the 10-year Treasury to start to get up closer to 2% as the year goes on, and maybe break above it before the year is out. The next slide, just looking at some other considerations, just to give a sense of how broad this recovery is going. We like to look at freight as a good indicator of demand and so forth. And there's a good correlation, as you can see here, between freight being shipped, this is particularly truck tonnage, and stock prices. They tend to follow each other. And we're seeing similar signs for shipping, whether you're using rail, air shipments, or actually cargo ships and so forth, tell a similar story. So good news there. The next slide, back in 2015, when we were starting to get a little bit optimistic that we weren't going to get into a recession and we're going to start to move a little bit better, we talked about the possible game-changing aspect of fracking and this whole new energy sourcing, horizontal drilling and the like. Would change the economic landscape for us. And today, the U.S. is the #1 oil producer for the 3rd month in a row in December. We're net exporters of oil for 3 months in a row, and the first time that's happened since the 1970s. Texas alone, as you can see here, if it was a standalone country, would be the #4 country in the world in terms of producing oil. And that renaissance started up in North Dakota. It's gone down through Texas and Oklahoma, and now it's moving into New Mexico. And I think nowhere has this change been more evident when you think about what happened last weekend with the problems in Iraq and Iran and the jetliner being shot down. If that had happened 10 years ago, we would have seen the price of oil jump up over $100 a barrel overnight. And the fact that we only moved up $3 or $4 gives you a sense of what our energy renaissance means in terms of stability to the global energy markets. And the same story holds true for natural gas. The cost of gas now in the U.S. is about half to sometimes a quarter of what it is in some other countries. And 10 years ago, when we were wringing our hands about companies leaving the U.S., going other places because it was cheaper to work, now if you're an energy-intensive company like steel, chemicals, cement, and the like, they've been coming back to the U.S. over the last 5 or 6 years because of the energy advantage they have. So this is going to continue to reap us some benefits. On the next slide, obviously trade is a big issue, and this week we got the Phase 1 China deal being signed hopefully tomorrow. USMCA is about to be in place, and then we've got a deal that's almost done with Japan. So our 4 biggest trading partners are coming on board, and I think all the angst that kind of hung over the market in 2019, which kept GDP a little bit slower than we initially thought for last year, that headwind, if you will, is going to kind of disappear, and I think that's going to give us a little bit more lift for this year. We like to look at total trade. I mean, the papers always talk about the trade deficit, and it's like total trade is what matters because that's what brings countries together. If nothing else, it promotes peace and prosperity. I mean, the fact that we've been able to negotiate something with China, without, the threat of violence and things like that, kind of tells you how important it is and how people are more focused on trade and so forth. And more importantly, the last time we ran a trade surplus was back during the Great Depression, and that didn't work out too well. The next slide, I've used this one to kind of close over the last 10 years, but going back to the late 50s, early 60s, the U.S. economy has grown on average about 3.1%. The Great Recession in 2008 and 9 was so bad that we got off track, and for 7 or 8 years we were only growing at about 2.2%. Over the last couple of years, we've picked it up to 2.6, and I think we're going to continue to improve here. Hopefully to get back on track, but there's going to be some headwinds. It's not going to be that easy to get back up above 3%, but at least we're moving in the right direction. On the next slide, just kind of summing up our year for this year, we don't see a recession. I think the biggest thing looming on the horizon right now are the November elections and what happens in terms of policy changes. Are there going to be ratcheting back of the regulatory cuts or more taxes and things like that? That might change the business dynamic. The Fed's going to stay on the sidelines. We expect strong employment to continue. The effects of the tax and regulatory reforms continue to pay dividends. I mean, over the last 3 years, just the cuts in regulations, hundreds and hundreds of regulations have been tossed out, and each of those had hundreds of pages. I mean, anybody who's in a small business knows every week it seems you're getting bombarded about something else you have to worry about and so forth. So the amount of things that have been cut in the last 3 years are phenomenal. You might remember back in the 70s and early 80s when the government first deregulated the airlines and rail and trucking and so forth, and to some point energy. What's happened in the last 3 years dwarfs all of those combined. And at the same time, that the tax cuts also, people saying, well, that was one and done. That was for 2018-19. It's over. But we don't see that. We see it as a gift that keeps on giving. It lifts incentives to work, to invest, run businesses, and so forth. And some people say, well, investment in plant and equipment hasn't been all that strong given the tax cuts and so forth. But you think about the old way, when people would get a tax cut and so forth, you'd go out and spend money on equipment and maybe computers and give them to your employees and say, go out and make me some money. But I think the new dynamic today is changed, where companies now are putting out apps and so forth, and they're letting their customers tell them what they need. And then they go to their employees and say, well, get on your computers and make this happen and so forth. So I think companies are getting much more efficient that way, and I think it bears it out in why corporate profits have held up so well. As a result of that, productivity has picked up. I think the last 3 years we've been running at about 1.4, 1.5, which is quite a change from the prior 3 or 4 years. We were down around under 1%. So companies are getting a little bit more efficient. So to close it up, I mean, we think this expansion obviously is not going to last forever. But reports of its demise are greatly exaggerated from where we sit. But on the next slide, just another thing to put in context. You just think about all the things that make us more efficient and productive, over the last 10 or 15 years that weren't there before. And so we were talking about Uber the other day with a friend of ours that lived in New York, and how that changes getting around in New York City and so forth. And the guy said, well, you remember back in the 80s, I used to keep an empty briefcase under my suitcase under my desk. And if it was raining, I'd take it outside because I'd get a cab to pull over, because he thought I was going to the airport, but I was just going, 3 blocks down the street. But not having to worry about things like that is pretty cool. On the next slide, we put out a weekly update. A lot of our clients get it, and a number of our prospects too. If you like to keep abreast, obviously things are going to change, and it's not going to be a smooth year. We're going to have some headwinds and things that pop up, and we'd like to keep you abreast of it. We put out the weekly report on LinkedIn, and we also email it out to our clients. If you'd like to read it, receive it, there's no obligation. It's simply a service we put into our clients and friends and so forth. Just let me know. So just to keep on time, I'd like to stop there, but I did leave a few minutes. If anybody has any questions about certain segments of the economy or something I said, I can try and answer them before I turn it back to Darpin. Yes?
So with the federal budget deficit at $1 trillion, how concerned should we be about that?
It's a concern. I mean, obviously, you see the number goes up. I mean, the numbers are mind-boggling. Two things. You remember that chart we had up there in the 10-year Treasury? The fact that long rates are so low, it tells us that investors yet aren't concerned that the U.S. can't pay their bills, that we're issuing debt, we're going to be good for it. Otherwise, you'd see long rates start to spike up in a big way. But I heard someone else explain it even better a while back, and he said, think about the U.S. economy is about, when you look at all private property, forget about the government land and so forth, is worth about $230 trillion, okay? And that $230 trillion generates about $22 trillion every year of GDP, okay, just from doing business. And we owe right now, the government debt is about $20 trillion. So all those zeros, 12 zeros, I can't get my head around it. So he said, think about it this way. Take off a bunch of zeros, and let's say you got a rich uncle who's got an estate worth $200 million, $220 million. And each year that makes him $20 million, $22 million in income. And you just got a telegram today, and your uncle unfortunately just passed away, but he just left you his estate. So you've got this new estate that's worth $220 million. If you sit on the couch and watch TV all day, it's going to make you $22 million every year in income. Now, there's one caveat. Your uncle had about $20 million in debt, okay? So you got to deal with that. And you say, well, I wouldn't be too mad at my uncle, okay? That's like 1 year's income to take it off. So in that context, the economy of scale of the U.S. economy is so huge. Obviously, we'd like to get it down. And spending is a huge problem. And I don't know how we're going to address that, because the government budget is what, about $3.4 trillion every year. Unfortunately, $2.4 trillion of that are entitlements, okay? Social Security, Medicare, and so forth. Supposedly, those are untouchable, okay? So you're left with the other small amount that you can cut for defense and things like that. So you can go at it and so forth, but I'm not sure how much is going to pull that back. But the short answer to your question is, right now, the market isn't all that concerned. And the 10-year Treasury would be a good barometer to tell you if the market is starting to worry about it. Yes?
What about me, meaning Connecticut?
Well, Connecticut has some headwinds, obviously, but when you look at the different, what do you call them, groups that have gotten together to try and address it, I mean, they're two different situations, two different stories, but I think about where Rhode Island was 10 years ago, okay, with government taking over the schools and so forth, and they've been able to wrestle a way out of it. We had a dinner that one of our bankers up in Hartford put on about 6 months ago, up in Glastonbury, with one of our legal partners. We put on a dinner and we brought in about 12 CEOs of Connecticut, just manufacturing companies. And these ran the gamut from guys that made sheet metal all the way up to precision gears that went into aircraft engines and so forth. And I expected not a lot of good news. I'm thinking these guys are going to be a little bit upset, but I was amazed to a person. They said, this is mid-year 2019, we're having the best year we've ever had, and to hearken what I said earlier, our business would be 20 to 30% bigger if I could find quality workers. So rather than wait for the government to help them out, what a lot of them have done, these are people maybe out in Willimantic and places where you don't have a huge labor pool, they've gone to like local technical schools and community colleges and started their own programs in manufacturing and so forth to get people trained, kind of taking the bull by the horns that way. So obviously there's a hill to climb, but it seems like people are making the right steps to say, look, we can't go on the way things are. And you saw that number at the 0.2% growth in employment last year. If there's a bright silver lining in there, public employee employment was down about 15%. So, there was growth in the labor force, and it's going more to the public sector, which, depending how you look at the numbers and so forth, tend to be more productive. So it's a big rock to push uphill, but I think people are moving in the right direction. And the best thing about that is if you're going to be in that type of situation, you want to be in an economy in general that's moving along because you'll get a little bit more lift as opposed to doing it when things are bad. So we're optimistic that, Connecticut will find its way and catch up with the rest of the group. Yes?
In your thoughts, if I got that right.
Yes.
Like 1 year, 3 years, 5, 10?
I would say, personally, I would say we're probably going to get through 2021 unless what the papers like to call a black swan event. I mean, something like what happened last weekend that escalates or something. But right now, believe me, you read the news every night. If they haven't looked under every rock and cranny to find the next thing to worry about, they would have found it by now. So the election is a big thing. That'll be a game changer if there's a shift back to higher taxes and more regulations and so forth. That'll put more pressure on businesses. Obviously, if spending continues to rise from a government standpoint, that kind of crowds out the private sector and make it a little bit tougher for companies to borrow and get money. But assuming no change in November, I would think that we could probably go another couple of years without a slowdown. Because as I mentioned earlier, this hasn't been the greatest recovery on earth. I mean, as I mentioned, we've only grown on average the last 12 years, on average about 2.4%, something like that. It's not great, but the one good thing that comes out of that is that keeps inflation in check, which in turn keeps the Fed on the sidelines. And as my #1 chart up there shows, they're the biggest threat out there. So with them off the sidelines, in that chart of all the things that have been created in the last 14 years, we're getting better at getting better. And I'm really optimistic that the entrepreneurial spirits, both here and nationally, are going to continue to drive innovation and so forth and continue to grow us, assuming there aren't obstacles put in their way. You doing okay? Okay, I'm going to turn it back over to Darpin, and if there's questions at the end, we'll try and answer them. But thank you very much.